Now, it's been said that a market only trends 30% of the time. Now, I can't quantify that figure, but having a range trading strategy to take advantage of the other 70%, it's pretty good business. Now, range trading, it's not difficult. However, it does require discipline and a method of determining when a trading range is in play. So what's range trading? When a market is trending, you're going to see a stair-stepping pattern of higher highs and higher lows in the case of an uptrend. There's an imbalance of buyers and sellers, and you can generally see the difference between an impulse move and a corrective move. Impulse moves are stronger and bigger in scope than a corrective move. Now, once that condition stops, markets tend to find themselves stuck between a high and a low and continue to oscillate between these 2 points. Buyers and sellers have found a point of relative equilibrium, and you can find yourself in a very choppy trading environment if attempting to trade between the 2 extremes. Now, this is when traders will place trades against the high or low extremes and will continue doing that until a price breaks out of either side. So we just come to the first issue with range trading, and that's finding the 2 points that are going to act as potential support and resistance levels to trade against. Now, I did a piece on support and resistance a while back, and I blanked out the chart, and I randomly laid on some horizontal lines. Turning the price bars back on, price did find support and resistance on every single line. Of course, that does not discount the validity of support and resistance, but it does bring home the fact that price can and will bounce seemingly from a random level on the chart. Now, to ensure you're using a level that may have some importance, levels that are obvious would be a better place to watch for price action and potential trading opportunities. Now, this instrument, it's trending down, and it puts in an obvious low at number 1. For the downtrend to continue, you're going to need to see this low taken out to continue our pattern of lower highs and lower lows. Now, price rallies, and when the price starts to drop, we have our high at number 2. Now, the issue is you have a potential pivot at number 3, and is confirmed when the price at number 4 takes out the number 2 high. Now, has this market gone right from a downtrend to an uptrend? No. Now, you're going to see later that price does fall back and does take out the number 3 low, and you can clearly see that price is not in a trending pattern. You have the extremes of our range labeled as number 1 and number 2, but number 4 highlights an important fact about these levels. They're not a defined price. When you're looking at these turns, consider them to be a zone with a margin of error both outside and inside the range. Range trading will take into account both extreme zones, and a trader will look to position a trade against the potential zones of support and resistance that form the range. Now, why potential support and resistance? Well, you don't know what's going to happen when price returns to these extreme zones. It could stop, it could reverse, it could break out. These zones potentially have an effect on price, and keeping that word in mind will keep your expectations in check when confronted with the meeting of price and the zone. It will stop you from simply pushing the buttons and taking a trade, and it's going to force you to look for signs of what the probable move may be. Now, trading range equals consolidation. When trading trends, most people are used to the impulse and corrective swings in the market. These pullbacks and rallies are continuation patterns of the overall trend. Well, the same can be said about trading ranges. More often than not, a range is a price consolidation as part of the overall trend move. It certainly can be the ending of the current trend and a reversal is imminent, but that has to prove itself and just not be assumed. Now, we all know there's 4 phases of a market: accumulation, markup, distribution, and markdown. And it is possible that the consolidation you're looking at is either an accumulation or distribution. And let it prove itself to be a trend change or show a clue such as a higher time frame divergence, but assume that a continuation play if you're trading the smaller time frame. Now, ranges can also occur when the higher time frame becomes overextended, and the range is where that condition is being worked off. Now, the first chart showed a range on the daily chart that occurred after about 148 days of an overall downtrend in the market and 27 days of an impulse leg that terminated at the number 1 low. Now, this chart here shows the weekly chart of the same point in time. You can see that the price had 2 weeks of a momentum push to the downside, and our indicator shows an oversold state. Our daily range played out for 63 days, but a quick look at the larger time frame showed an extended and oversold market. The higher highs, higher lows, lack of divergence, and a lack of reversal price action pointed towards a trend continuation and not a reversal. There's risks of range trading. There's a few issues with trading the range, but many of them can be avoided if the trader is disciplined in the trading approach and knows what to look for. Having a read on price action will also go a long way in helping you take advantage of the opportunities that range trading provides. Now, it runs to the range extremes. Now, you've probably heard it said that the more time something is tested, the stronger it becomes. Look for multiple touches to confirm strength, is the quote. No. I go on the opposite premise that multiple runs to a level and actually weakens it, doesn't strengthen it. If a price level is important enough to reject price, why should it continue to revisit that area multiple times? If it's going to revisit multiple times, I would also expect to see the move away getting stronger and not weaker to indicate strong interest at the extreme. I also look at the number of times the traders take positions against the extreme and they place their stops just on the other side. If that breaks, especially in the direction of the higher time frame trend, a protective stop cascade could propel price hard, fast, and when those protective stop orders get hit and they turn to market orders, how much slippage is going to occur? The point is not to blindly take a position simply because the price has moved to an area from the past, especially after multiple hits at the extreme. Remember that markets cycle through ranges and trends, so eventually one of the extremes is going to break. Now, if you want to fade the extremes, you want to see some type of failure or signs of a reversal at the extremes. Now, on the other side of the coin, you don't want to assume that you're going to have a trading range breakout simply because price moves strongly towards an extreme. This chart here shows a range, and at number 1, you can see the strength in the candle as price pushes towards a potential resistance area. You know people bought into this move, and the small upper shadow shows a very small number of sellers. Now, just as strongly as price advanced, it collapsed, and once it was obvious that the range breakout was not going to happen, a large momentum candle shows up that could indicate the buyers exiting their positions. It could also indicate that those who bought at the small consolidation or at the support extremes are just taking their profits. Regardless, anticipating their trading range breakout served up a healthy amount of losers. The price advances once again to the potential zone of resistance, and price action at number 2 shows the imbalance of sellers and buyers at the extreme that could be used for a trade entry. This is a picture-perfect reversal, although it was not a strong continuation away. Now, you would not know any of that, of course, and that's why trade management must be part of a range trading strategy. Now, if you're looking to fade either extreme, this next chart shows the type of action you do not want to see. It's not a perfect example, but understanding what is happening is important. The extreme's been in place for quite a while, and it's seen multiple reversals in that area. The last one is different. The reversal on the left had signs of indecision until sellers took over. The last push up has consolidation right at the extreme, and there doesn't really appear to have much of a bull-bear battle taking place. You could also see part of the uptrend pattern of higher lows taking place. We don't want to see a pattern of higher lows into the resistance extreme nor lower highs into the support extremes. We do not want to see accumulation at either extreme. Now, while a reversal could still happen, this type of price action and structure at the extreme does not give much confidence for shorts or longs. If anything, some traders may find an entry inside of the consolidation at the failure test candle marked with an arrow. Now, expanding trading ranges. When you see price break out of both extremes and failing to trend, plus each swing is larger than the previous, you get a range that's expanding. This is not something I want to take a part in, as the market has no clear-cut consensus on what it wants to do. Also, if taking a position in this type of